Hey there, good evening, everyone, and welcome to My Theo Live. My name is Roshan Kanesan, Head of Content and Strategic Partnerships here at My Theo. Just a quick reminder for all of you in the audience today, My Theo is a digital investment manager, more commonly known as a robo-advisor licensed by the Securities Commission of Malaysia. Now, first things first, can everyone hear me loud and clear? Let's do a quick sound check. If you can, just let me know in the chat box. Or yeah, I see that they've got Owen raising his hands. I presume that indicates that you guys can hear me. Fantastic. All right, awesome. Thank you, Harimon, for responding to me. So today's webinar is, in today's My Theo Live, we dive into the question, how much does an iPhone 14 really cost? And this is a story, of course, of compound interest, the power of compounding, and opportunity cost. But first, let's get through some housekeeping. First things first, I would like to share with all of you that we are going to be, over the weekend, we're going to be at Invest Smart Fest 2022. As you can see on screen, the theme as it has been, I think recently is Silap Labo, Do It Labo. We will be there from 10 to 10, Friday, Saturday, and Sunday at Kuala Lumpur Convention Center. Come over to the FinTech Pavilion and come and see what we're up to over there. Come and chat with us if you're interested in My Theo, but want to learn a lot more. Yeah, so we'll be there over the weekend. Please feel free to stop by. I'm more than happy. We are all more than happy to speak with you. Now, let's pull up the slideshow. The deck anyway. So ladies and gentlemen, as I mentioned, today we're talking about how much the iPhone 14 really costs, a story of opportunity cost and the power of compounding. A few other things we need to go through before we proceed. Right now on screen, you should be, right now on screen, we've got a disclaimer notice, of course. Amongst other things in this notice we should pay attention to is that nothing here should be constituted as an offer, solicitation, or recommendation. Ultimately, you have to speak to your own financial advisor or financial planner before taking on something before taking on a financial product. All this information here is for informational and illustrative purposes. And end of the day, if you do need a consultant unit advice, please seek that from your financial advisor, someone that's licensed by the Securities Commission of Malaysia or the relevant body. Always remember that portfolios involved have principal at risk. And last but not least, past performance is not indicative of future results and is not a warranty or representation, and no representation or warranty is made regarding future performance. All right, just keep an eye on a few things here. Again, I didn't cover all the details there, so please take note of them if by taking a screenshot or photo or however else. Now, a little bit about me. My name, as I mentioned earlier, is Roshan Kanesan. I have many times in the past described myself as a personal finance nerd. As you can see through the bio here, whether it was running Wing and Sense or becoming a financial planner or eventually ending up at My Theo as the head of content over here, the journey over the last 5-6 years has all revolved around personal finance and being able to communicate that with a larger audience, which is why I'm glad to be speaking to you, to all of you, lovely people today. So we highly encourage people to put in questions. So please, you will see the Q&A box somewhere on your screen. Put all your questions in there. Matt and I have discussed that we would love to give you guys at least 20-30 minutes for Q&A. So we're hoping that the presentation takes 30-ish to 40 minutes, and then we'll have around 20 minutes for Q&A thereafter at the end of the session. All right. Last thing before we get into the introduction for the session itself, who is My Theo, right? We've got a few people here, quite a few people who are not customers of My Theo. So at My Theo, we try to make basically sophisticated tools for investment in a very simplistic package, right? So some of the things you're going to notice here, as I mentioned earlier, we are a digital investment manager licensed by the Securities Commission. My Theo, among other things, provides a highly personalized investment management system backed by decades of professional experience, including Matt's own experience as well. We've got proprietary technologies, including our functional portfolio approach, as well as essentially the entire system is run 100% on algorithms. It's ensuring that we are minimizing human bias and eliminating emotional decision making. And so far, it's trusted by over 130,000. The investment strategy is trusted by over 130,000 investors across the globe. So let's talk about today's session, right? So I've kind of a bit of clickbaity. I tried to use the iPhone 14, the title here, to kind of break it a bit more, to make it a bit more friendly to the search engine. But ultimately, whether it's the latest iPhone, Samsung, or Google Pixel, I know the Google Pixel recently came out as well. The question is, how much do these pricey purchases really cost you? I do want to emphasize here, we're not trying to tell you how to spend your money or what you should be doing or any kind of moral judgment. What we're saying is there's always something to be thought about when you make a decision. Because money spent somewhere is money not spent somewhere else. So the latest and greatest smartphone could cost you 4,200 ringgit now, but if that money was invested, it could be worth maybe just under 32,000 ringgit in 30 years' time. That's about 7.6 times more. And this was based on a 7% annualized compounded rate. As Matt will go into the notes later, the equity markets on average over the longer term have averaged, global equity markets have averaged around 8.5%. So this idea, right, the spending money somewhere else doesn't allow you to allocate it somewhere else. That's called opportunity cost. So to explain the power of compounding and the unseen cost of buying the latest and greatest smartphone or anything for that matter. Today, of course, like all times, we have My Theo's Chief Investment Officer, Mytheo Stuart-Box. Mytheo, many years in the industry. He was Managing Director of BlackRock Japan in Tokyo and San Francisco, was running also served as the head of scientific active equity, responsible for managing Asian equity portfolios totaling around 10 billion ringgit in assets. Also enjoys playing football in his leisure time. That's just something that, we have to create a personality for you, Matt. So we have to introduce all these different elements to it. But long story short, Mytheo, good to have you on the show again. How are you doing?
I'm good, thanks. Yeah, how are you?
I'm doing well. Looking forward to this conversation as I always am. Now, for those who are new, what we're going to be doing is I've got some questions for Matt that I will ask him, and he will dazzle us with basically slides that he's prepared for us. So, Matt, I'm going to stop sharing and hand the screen over to you. All right. So, ladies and gentlemen, again, let me remind everyone that we are more than happy to take questions and answers. So, to do a Q&A session. So please let us know if you have anything that you'd like to ask us in the chat box down below, right? So just click the Q&A tab and you should be able to ask us a question. So just give Matt a second to get to the slide. All right, great. So Matt, your introduction aside, is there anything in particular you would like to highlight about your career so far? BlackRock is a really big name. And I have asked you this before, but maybe you could remind some of us here, what was it in particular that you were doing at BlackRock?
Sure, yeah. Thanks, Roshan. Yeah. So I was at BlackRock for a total of 18 years. I was a portfolio manager, looking after, as it's on here, Asian equity portfolios. And my role was as a quantitative portfolio manager. So we were building investment models that tried to identify stocks that were likely to outperform. And these were based on quantitative models of kind of modeling the fundamentals of companies.
Right. So a lot of essentially, again, fundamental analysis, but done through a quantitative style, right? So it's not to be confused with momentum or technical analysis.
That's right. Yeah.
Right. So I think we can hit into this, the first question now. My first question to you, Matt, is this. As my introduction alluded to, we're going to be talking about the power of compounding, right? This is an essential concept in long-term investing and the key financial goals, such as retirement planning. But before we even get into the power of compounding, I think it's really important for us to understand why investing is important, because this is something, like as our colleague and boss Ronnie likes to say, these are motherhood statements, right? Retirement planning or investing is important. Yes, it is important, but why is it important? I think this isn't articulated well enough. So sometimes there isn't a real commitment to do it. So maybe could you help us shed some light into this? Please.
Exactly. Yeah, sure. Yeah, I think it's a very fair question, to be honest. First of all, let's think about what is investing. This is a very common kind of definition if you look it up of investing. So it's pretty obvious. It's the process of buying assets that hopefully are going to increase in value over time. And so As they increase in value, they're going to provide you with returns, basically in two forms normally, either in the form of income payments, the bond interest payments or dividends from stocks, or in the form of capital gains, where the price of the asset goes up over time. And so the process of buying these kind of assets and trying to increase the value, that's what we think of as investing. Why would you invest? Well, the simple reason is to generate wealth. You're hoping that what you buy will go up in value, and so you'll end up with more wealth than you had at the start. That's very fair. But if you drill down a little further, I think there are many different reasons for investing. I don't think everybody invests for just the same reason. You could kind of think of three main reasons perhaps for investing. Maybe there are others. One is to kind of just simply grow your assets, to end up with a larger pool of assets 30 years or 40 years down the line. That's a perfectly valid reason for investing. It's probably the most common reason for investing. But if you think about it, there could be other reasons as well. You might invest to generate income, potentially, in particular, if you're at retirement or close to retirement. Perhaps you're not looking to grow your assets so much as to provide some kind of stable income every month. That's also a perfectly valid reason for investing. And then you could also think of, especially right now, one very good reason for investing is to try and protect the value of your assets against inflation. Obviously, just leaving your cash in the bank is going to earn you a return in terms of interest, but in many countries right now, the interest you'll earn on your cash is less than the rate of inflation, and so the real value of your assets is falling if you just leave it in cash. Whereas perhaps if you invest in some other assets, perhaps they will increase faster than inflation to be able to protect you against it. So those are all perfectly valid reasons for investing. Or if you think a bit slightly differently, what can you get from investing? What can it give you? Again, I could think of maybe three things. One, it can give you an element of security. Having a pool of assets is a good form of insurance. If something goes wrong and you need some money at some point, having a pool of assets that you've built up over time provides you an element of security. Perhaps a different way of saying it is it provides you with an element of financial freedom. This is a very common term a lot of people use. In the longer term, if you built up enough of a pool of assets, it can mean that you're not dependent perhaps on a monthly salary, or you have less dependence on a monthly salary, and that really is a form of freedom. It gives you some more options about what you can do. The other thing, of course, is having a pool of wealth, a pool of assets can provide new opportunities for you. You could use those to perhaps buy a property, launch a business, provide gifts to your children as they get older, those kind of things. And so rather than thinking about investing in terms of growing your assets or generating income, it can provide you with an element of security, an element of financial freedom, and a range of new opportunities, I think.
Okay, so we've pretty much laid the core of why investing is important here. From that, let's go talk about the long-term potential that can be illustrated by the power of compounding. As I mentioned in the introduction earlier, Matt, the price of the base iPhone 14, which is around 120 gigabytes, is now could be worth 7.6 times in 30 years' time if invested and compounded at 7% annually. Now, it's a little less than the average global market rate, but that I just used a more conservative model for this. So we know its potential, but what is compounding and how does it work?
Sure. Okay. So compound interest is, as you say, is a core concept in investing. It's absolutely critical. And what it really means is when you earn interest, both on your original investment, the original cash that you put in, and also earn interest on everything that you've earned in the past as well. And so the easiest way to see this is to look at a very simple example. And here I've used, to make it the numbers easy, an example of, say, if we invested $100 and it returned 10% per year in terms of interest. And you didn't touch the interest, you left it as it is, so it all piled up. Then what would happen? Well, in the first year, it's very simple. You've put $100 in, you're earning 10% interest, so you earn $10. Mm-hmm. That's very simple. But now your total invested cash is not $100 anymore, it's $110 now. And so in year 2, when you earn this 10% interest, it's being applied not just to the original 100, but the total of 110. And so now in year 2, you earn $11 of interest, 10% on $110. So you're earning an additional dollar in year 2. And so now your total invested cash is the 100 plus the 10 plus the 11. So now you're sitting at $121 of invested cash. And so in year 3, all of that earns interest. And so you earn 10% of 121, $12.1. And so on through time. You can see each year, as you go further down, the amount of interest that you earn increases. And so the value of your assets grows, but it grows at an increasing rate. It grows faster each year. You can see the amount of interest, the increase in the value of your assets gets bigger each year. That's the core element of compound interest. In this example, I've kept it very simple, and I've only gone out for 5 years. But when you get to a longer horizon, some of the numbers can get very big indeed. It can have a very big impact indeed. This is one of my favorite quotes in finance. It's a surprising one from Albert Einstein, of all people. His quote was, "Compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't understand it pays it." You mentioned earlier, long-run average global stock market return is about 8.5%. I mean, it varies a bit from time to time, but in the long run, the average is about 8.5. So let's look at what would happen if you just put some cash away in global equities and just left it to compound over a long period of time. So the graph on the right-hand side here shows the value of those assets over a long horizon. So you can see down here, we start at 100. And in the first few years, it grows roughly linearly. You get your interest coming in, it goes up to 109, 118. But gradually, as your investment horizon gets longer, the interest that you earn each year gets bigger and bigger and bigger because it's compounding on a bigger base each year. Mm. And so by the time you get to, say, 30 years, the value of that $100 has increased more than tenfold. It's up to $1,156, simply from this 8.5% every year compounding each year. And then if you take it out to something more extreme, you look at a 50-year horizon, then you've got 6,000 ringgits, almost 6,000 ringgits. So the value of your assets have gone from 100 up to nearly 6,000, so nearly 60 times that. And so you can see this power of compounding, especially when you're looking at a longer horizon, is really quite spectacular. And so in that sense, from the point of view of what you've got to do to invest, in a sense, it's very simple. Here we're just assuming the returns of the long-run equity market. We're not assuming anything kind of fancy in terms of active returns or anything like that. All you need to do is, so long as you've got the time, all you need to do is just invest in the market, leave it there, don't touch it, and allow those returns to compound.
And Matt, when you take a look at the graph like that, the first few years can be a bit tough, right? Because as you mentioned earlier, it's linear. It takes really some time for that compounding to really do its work, to have that magic. So even when I was a financial planner for a little while, licensed financial planner, and always trying to expand and financial educator, and in our syllabus, we always try to show people that over the longer term, that 20-year mark is really where you start to see really some of that magic start to happen. The 20, 30-year timeline is when you start to see the interest amount that you've collected be more or amount to a higher value than your actual principal, and which is very similar to what we're seeing here. At the 10-year mark, it's doubled, and this is a higher rate of return. At the 20-year mark, it's not doubled, it's quintupled at this point, which is already a really fantastic return. So at the beginning, it's a bit slow, but then once the acceleration picks up, that's when you really start to see some of that impact take place. Yeah. Okay, so Matt, that's the power of compounding, very nicely put together. But the big question here always, I think, or something that I ask myself sometimes is, what would happen if we keep taking our returns out, right, instead of letting it compound? Now, this makes a big difference here. So, for example, from a Malaysian context, let's say you have a big chunk of money in EPF and you keep taking it out, your dividends out. So you're not keeping in. That's an example of not letting your returns compound. Yeah, what would non-compounded investing look like as compared to compounded?
Yeah, sure. Yeah, I think this is a very good comparison. And you can do exactly the same calculation, but as you say, don't compound the interest. And that, as you said, is equivalent to you just taking out the interest each year. And so the returns don't compound. And so this graph here is exactly the same kind of calculation. So the blue bars are exactly the same as the previous slide, but the orange bars are without compounding. And so you can see when you get out to a longer horizon, 30 years, 50 years, there's a huge gap between the two, roughly 10 times the size. And so after 50 years, with compounding, you get to this $5,900, nearly $6,000. Without compounding, you get 525. So a tenth of what you would have had with compounding. So over a long horizon, it makes a huge difference.
Yeah, and there is a place for non-compounded returns. Maybe when you're in retirement, yes, and you need to withdraw that money, you have to draw down that money to take care of your everyday needs. But when you're younger, when you're leading up to retirement, when you got 20, 30 years, you really do want to tap into that power of compounding to help you get to that mark. I mean, recently, the Chief Strategy Officer, Roshan Kanesan of EPF, mentioned that Malaysians would need about R1 million to retire in 20 years. So these are these numbers that they keep getting bandied about right now. So, and I guess that's where My Theo as an investment product is also trying to help people achieve those goals, right? And Martha Ling has asked us, how does My Theo work? Martha, we will get into that. So please stay tuned. But please keep asking us more questions. And as we go through how My Theo works, if you need more clarification, please ask the question, as Owen has put in the chat there. We are more than happy to take any questions, okay? So Matt, that's one way of doing this compounded calculation or this non-compounded calculation, where we talked about that cash outlay, 4,200 ringgit, for example, you put up for a phone, and what that could amount to in a few years or in a few decades' time. That's it, though. Nowadays, you don't have to pay for your phone upfront. All right, you can do multiple installment plans, whether it's with the carrier or with the credit card companies that want you to buy more things. So whether it's a 24-month, 12, 24, 36, 48 months, it really depends on who your credit card company is. So if we take that, for example, if we take 4,200 ringgit, sorry, 4,200 ringgit and split it over 48 months, right? What that would look like is 87 ringgit, 50 cents a month. Now, that doesn't sound too bad, Matt. So what are your thoughts on this, essentially? Or what kind of comparison can we... Oh, yeah, exactly that kind of comparison.
No, you're exactly right. Nobody, well, very few people pay for their iPhone upfront. But even if you split it over this, say, in this case, as you said, 4 years, there's still an element of compounding that you're missing out on. And so what this graph is showing here is, as you said, split the cost equally over 4 years. That gives you just over 87 ringgits of payment per month. What would have happened if you'd taken that 87 ringgits and instead of using it to buy an iPhone, invested it in global equities? And you can see the gray part on here that's the additional return that you could have earned on those investments, assuming again the same 8.5% global equity return. And so you can see over the course of the 4 years, even though it's not as spectacular as some of the numbers we've looked at earlier on, had you invested that same cash, the 87 ringgits per month, you'd have had the 4,200 plus accumulated returns on top of that of 749 ringgits. And so in total, after the 4 years, you'd have had 4,949 ringgits. And so even though, the impact is not as spectacular as in the previous example, simply because the time period is that much shorter, even with these kind of monthly things, you're still missing out. There's still an element of opportunity cost involved here.
Right. And maybe you could go a little bit deeper in terms of, let's get into the elaboration around opportunity cost, for example.
Sure. Yeah. I mean, I think we've used this word a few times today, and to make sure people really understand this. This is the kind of dictionary definition of opportunity cost. It's what you miss out on when you choose to do one thing instead of another. And as you said right at the start, we're not advocating that you don't buy a phone or you don't go out and buy an iPhone. That's not a practical idea. Everybody needs a phone. But what there is this point here that you should be aware of the true cost of these kind of things, and it's not simply the sticker price that you're paying. If you take the same kind of calculation, a 4-year horizon with the 8.5 returns, if you pay up front, then the opportunity cost is not just the 4,200, it's all the returns that you've given up from that. So that gives you an opportunity cost of 5,364. Or if you do it in monthly installments, that's the number that we just saw, the 4,949. And so this is not to advocate any particular thing in how you spend your money, but it is important to take into account that spending money today means you miss out on an element of these future returns. And you should take that opportunity cost into account, I think, when you think about how to spend your money right now.
Yeah, because at the end of the day, the way we allocate our cash, our hard-earned money, it is within our discretion, right? Whether we want to buy the latest phone or not. But I like advocating for something Ramin Sethi likes to use. It's called conscious spending. I know it sounds really woo or really simplistic, but it's the idea of just being very conscious about how you spend your money, which is not something that I think is not as entrenched or as obvious as we like to think, right? Because sometimes common sense isn't as common as we like to think it is. So this was something that really changed my own, like when I'm going out to, let's say, for example, again, I'm not telling people to stop buying lattes. I buy a latte every day, but I do it with an intent, right? It's not a habit. I'm not unconsciously picking these up or unconsciously paying for a much higher phone bill, a telco bill than I should be paying for, or unconsciously buying a phone every 1-2 years, even though my current phone works perfectly fine or acceptably fine. It's about doing that internal analysis, whether this is a conscious expenditure. Now, maybe a little bit on a high horse there. Apologies if that sounded like moral judgment. It's not. I love spending money on things like this. In fact, I'm doing this debate right now. Do I buy an iPhone 13 or an iPhone 14? So that's an internal debate that I'm struggling with at this point. But Matt, when we talk about investing, when we talk about all these things about compounding, about the opportunity cost, oftentimes the importance and the potential of investing can be overshadowed by fear, anxiety, and uncertainty, right? Leading to procrastination and inaction at the very least. So in response to this, we at My Theo believe that investing can be made easier with ETFs and algorithms Maybe you can help us elaborate on this. Maybe I know you like using a Warren Buffett quote to talk about whether investing is difficult, and then maybe we can get into ETFs and algorithms and how My Theo uses that. Martha, we're about to answer your question as well.
Yes, yeah. So hopefully we'll be able to get at those kind of questions. 7 years, yeah. So thanks, Melissa. So this is even more than the quote about compound interest. This is my favorite quote in the whole of investing. The idea that investing is simple, but it's not easy. And there's a lot behind this kind of quote. It's simple in the sense of all you need to do is allow compound interest to work in your favor. But people don't find it easy. I think there's a lot of different reasons for that. But one of the simple reasons is people's own behavior. People find it hard to stick to a simple plan, to leave their money invested full time. They try to time the market. They try to beat the market. They try to do complicated things when really all you need to do is keep it simple. And as you said, Roshan, My Theo is all about trying to make investing simple, accessible to anybody. And there's really two tools that we use to do this. One is this idea of using algorithms. And so we'll talk a little bit about what algorithms are and how we use them. And then we also use ETFs to make investing easy. So we'll talk a little bit about what these ETFs are and why they make sense to use them in a portfolio. So let's start with the algorithms. Well, what is an algorithm? It sounds very complicated. It sounds very fancy, but really, in the investment sense, an algorithm is just a rule. It's just a rule for managing your portfolio. That rule could be sitting in your head or the head of your investment manager, or it could be written down and coded in a computer program and run automatically. It's still an algorithm. It's just a rule for managing your portfolio. Things like your asset allocation rules. How do you decide where to put your assets? Portfolio construction rules. How do you decide how to build your portfolio? How do you decide how to maintain your portfolio? Trade, things like that. The value of doing this is fixing these rules in advance means that when something happens in the market, you don't have to panic. You follow the rules. You do what you've already decided. And so this is a great way to reduce some of the emotion, some of the bias, some of the human bias that people get caught up in when markets are moving. Decide in advance how you're going to build your portfolio, how you're going to maintain it. In other words, use an algorithm. And then you know that when things happen, your portfolio will be kept up to date the way you wanted it to. In terms of how we use algorithms at My Theo, we have a range of proprietary algorithms. So these are algorithms that we've built ourselves, and they do all the things that I've just mentioned. They build your target portfolio, they decide the weights of the ETFs in the portfolios, they help with trading and managing the risk of your portfolio. These are all proprietary algorithms unique to My Theo that we built, we developed ourselves. Some people think of algorithms as being a kind of a black box, just a computer in the corner buzzing away.
Very common question that we get.
Yeah, and I can understand that, and I think some people do overemphasize that. The point is, all of our algorithms were built by humans. I built part of the algorithms. Also, we have an academic advisor, Yasuyuki Kato, who's a professor of finance at Kyoto University in Japan. He also has many, many years of investment experience. And you can kind of think of these algorithms as really taking this combined experience, this combined investment experience of me and Professor Kato and other members of the team, and systematically applying them to all of our clients. And so these are not black boxes. These are not things running on their own. There's always human beings behind the algorithms. There are human beings monitoring your portfolios every day. Live portfolio managers on the ground in Malaysia, and also the team in Tokyo.
So I guess a good way to look at that, Matt, as well, is, sorry to butt in, is that essentially we're using the human intelligence for its strengths, and we're using the robots on the algorithms for its strengths, right? Because basically once the rules have been, and we can put complex rules together or multiple rules or real-time rules that can be applied in real time that maybe humans can't do as quickly, right? So we're leveraging on both sets of strengths here. It's not to say that this is Terminator and the robots are here to take over everything. We've built the algorithm to essentially reflect the human intelligence, but to also remove that, as we mentioned earlier, that emotional bias, that human bias that may come into play during really tumultuous times, basically volatile markets and things like that.
I think that's a very good way of phrasing it. Yes, you do the humans do the thing that they're good at, and that is designing those rules. And then the machines do what they're good at, which is implementing those rules in an unbiased fashion. Exactly. It's not one or the other. It's a smart combination of the two. Yeah. Then maybe just to make sure we answer the question, we could talk a little bit about how, what the algorithm looks like from, say, like a user's point of view. And this is what it would look like for a new user of My Theo. We ask some very, very simple questions. There's only a small number of questions here. Things like your age, whether you're retired or not, what your assets are, how much risk, how long an investment horizon you want. And then based on those inputs, based on that information, our algorithm will come up with a recommended portfolio for you. This portfolio will be different for each person, depending on the information they've inputted. But it'll look something like this: an allocation to growth, these are equity elements, income, some fixed income ETFs, and inflation hedge, some real asset kind of ETFs. And then you'll be able to see kind of how this portfolio would have performed in the past. You'll be able to see also, some projections about how it might perform in the future. But that's what it'll look like to a client. And then underneath each of those allocations, there's an algorithm that builds your portfolio for your equity ETFs, your portfolio for your fixed income ETFs, your portfolio for your inflation hedge ETFs. Again, these algorithms were developed by us, and they run every month to make sure each element of your portfolio is kept up to date.
Right. And the next question that we have, of course, to follow up from that is that's the algorithm side of things, right? And just to emphasize again, each of these functional portfolios are their own portfolios. I know I'm repeating myself here, but sometimes we take that for granted. So the equity portfolio is a growth portfolio. It's focused on putting the algorithm, its own algorithm is designed to look at how we put together a portfolio of equities that are well diversified enough but are pivoted towards growth over the long term. Each of the different portfolios have their own goal in mind, right? And we can learn more about this in time. I don't want to spend too much time on that because it's already 9:40. But I do want to ask you a bit about ETFs as well, Matt, because we talked about algorithms here. Sure. What about ETFs and how My Theo approaches that?
Yeah, sure. Thanks. I'm sorry. Yeah. So ETFs are the other building block for My Theo, and most robo-advisors use these. And ETFs themselves are very, very simple. There's nothing fancy about them. They're simply unit trusts. There's nothing more to them than that. They're unit trusts that are actually traded on a stock market. In most cases, they track a specified index. So they're basically passive funds. But the good thing about them is they provide a very easy, cheap, transparent, liquid, because they're traded on an exchange. They're also a very tax efficient way of getting global exposure in many different kinds of assets, equities, bonds, commodities, real estate, a whole range of different things. There's thousands of ETFs in the globe. I think the most recent count is about 8,000 different ETFs listed in various different countries around the world. The total AUM, if you add up all of those ETFs, is something like $10 trillion. So this is a huge amount of investment vehicles. But they make excellent building blocks if you want to make a diversified portfolio. So if we look a little bit about like how it works in the case of My Theo, well, you can't hold 8,000 ETFs. You wouldn't want to. Our investment universe in My Theo is currently just under 60. It's 59 ETFs. So think about how you get down from this huge universe of 8,000 down to this 59. Well, the fact is a lot of ETFs are not that useful. So we filter out a whole load of ETFs, things that use leverage, these kind of bull and bear ETFs, those kind of things. ETFs that have very high costs, either costs in trading them or the expense ratio of the ETFs. ETFs that have poor performance, ETFs that haven't tracked the index that they said they were going to track. And to be honest, those ETFs do exist. We get rid of those. Also, you want to have a reasonable amount of history of the ETF. It has to be around for a while to be sure it's reliable. So we cut out the ones that are very new. And then we cut out ones that have low liquidity. Those ones are going to be very expensive to trade. You go through all of those steps and you end up with this set of about 59 investable ETFs. And those are the ones that we use to build the My Theo portfolios. This is what one of the portfolios looks like right now. So this is our growth portfolio. So this is focused on equities. And so you can see on the right-hand side here, this is the investment universe. So right now there are 20 ETFs in the universe. Some of them we don't hold at the moment. On the left-hand side, this shows the current weights across the ETFs in the universe. And so you can see the largest weights are things in the US, large cap value, large cap growth. And that's reasonable, I think. The US is 60% of the global equity market. But you can see we also have exposure to a whole load of different markets, the UK, US small cap, India, South Korea, Canada, a whole load of different countries. And so we're building a portfolio that's fully invested in equities, but also diversified in terms of different markets and different segments of markets, large cap, small cap, value, growth, that kind of thing. That's the growth portfolio. Similarly for the fixed income-based income portfolio, here it invests in a range of different ETFs, some that have treasuries, so government bonds, but also corporate bonds, investment grade, high quality corporate bonds, but also high yield bonds as well. Also things like emerging market, local currency bonds, those kind of things. So the fixed income market is a very diverse market. We make sure that the portfolio here gets exposure to a range of different fixed income assets. And then the inflation hedge portfolio, this is focused on real assets. And so you can see it holds things like real estate through REIT ETFs, but also things like gold, base metals, infrastructure, those kind of things. As well as these things, TIPS. These are treasuries, US treasuries, where the payout of the bond is linked to US inflation. So this is also another good way of hedging inflation. But again, you can see there's a range of different ETFs, a nice diversified portfolio, but all with the purpose of trying to hedge you against inflation. And as I said, each of these is built using our proprietary algorithms. And then each month we rebalance these things and make sure that everybody's portfolio is kept up to date and kept at their target allocation. So if you just wanted to like a simple summary of what My Theo is doing, this is a good way of visualizing it. You're taking some information from your client, these 5 questions that we looked at: age, retirement status, risk tolerance, that kind of thing. That's one set of inputs coming in at the top. And then coming in from the bottom, this universe of 59 ETFs. And then a combination of our algorithms is taking all of this information, and for each My Theo customer, building their own dedicated, customized portfolio that matches their needs with these portfolios of ETFs. I'll maybe leave it there. I think we do want to make sure we address some of the questions.
And
so,
we've got
should we leave the presentation here?
Yes. Matt, thank you so much for that. And everyone, thank you so much for your questions. Owen has dropped in a link there if you want to get started with My Theo. But we've got a lot of questions to get to. And I do want to start with this one here in the chat from Ryan. Ryan has asked, with My Theo, safe to say all I would need to worry about is making sure I keep up with my dollar cost averaging. As my risk profile changes over time, that means you get older, you can take on more risks and your goals shift. Will My Theo rebalance my portfolio accordingly? The answer is yes, but I'll leave the rest of that answer to Matt to handle.
Thank you, thank you, Ryan. That's an excellent question. Yeah, and the answer is yes, yes. That is all completely automated within My Theo. Obviously, at any time, you can also go in and change your settings yourself. So My Theo allows a lot of flexibility in terms of you going in, changing your risk tolerance, changing your horizon. You can do that at any time. You can also directly shift your allocation between the different functional portfolios if you want to. But you're quite right. The My Theo algorithm includes an automated element where, as you get older, as your assets increase, naturally your optimal asset allocation will change. And My Theo will automatically take that into account. This happens over a very long period of time, so the changes each time are relatively small, but year by year, My Theo will shift your target allocation as you get older to make sure it's appropriate for your current age.
Yeah, if I'm not mistaken, Matt, that happens every year on your birthday. And this is on top of the regular rebalancing that we do, the regular reevaluation of ETFs to ensure that the portfolios are in tip-top condition. So yes, on top of that, and then I mean, not to brag, but I think we're the only robo-advisor that does that right now. I'm sure in time people will also adapt to a similar thing. But it's something that even when I first joined, and again, I mentioned earlier, a bit of a personal finance nerd, it was one of the things that I was really happy to see, right? In terms of like this automatic change of risk essentially over the longer term so that I don't have to really keep an eye on that and change that on an annual or every so year basis. Next question here, Matt, is, okay, this is a bit, all right, so we've got one from, I remember an article in Bloomberg which mentions that the Bank of Japan is a major shareholder of ETFs at one point in time. Is there the danger of a big player such as that threatening the stability of the ETF market? Any notes on that?
Yeah, thank you. It's a very good question. Yes, I saw the same article, I think, and you're exactly right. Yes. So as part of like the Bank of Japan's quantitative easing, they have bought a lot of ETFs in Japan. Just to be clear, My Theo doesn't invest in any of those ETFs. So all of the ETFs that we own in My Theo are all US listed ETFs. The Bank of Japan does not own any of those ETFs. So from that point of view, there's no impact on My Theo. At some point, the Bank of Japan will need to unwind its position in Japanese ETFs. They'll do it gradually over a long period of time. But it has zero impact on anything to do with My Theo. All of our assets are held in US listed ETFs.
But what about, is there potential for impact by a large player even in the US ETF market? Could we see a similar parallel then? I'm not asking you to crystal ball that, but is there a similar risk to be concerned about in that sense?
Yes. The answer is for the ETFs that we use in My Theo, I think it's very unlikely that any single player would have the scope to disrupt the market. The US Fed does not buy ETFs. So that's out of the question. I think it's very unlikely that they'd ever buy ETFs. So the US Fed does not do it. As part of the filtering down of that universe down from 8,000 to 59, we cut out ETFs that are small. All of our ETFs have to be multiple $1 billion of ETFs. And part of the reason for that is to make sure that no single investor can dominate that ETF. So I think it's a very good point. You can mitigate a lot of that risk by simply buying ETFs that are large. So they have a very diverse investor base.
And I think better liquidity and all of that, so that there's no squeezing of that market essentially. Another really good question here, Matt, that's come in is, I think we talked about the algo and how we use our different algorithms here. How would you know if the rules that you choose for your algorithm or Mytheo's algorithms are still relevant under current market conditions? Pretty sure this is a very common question that we get. Over to you.
Yes, I think that's a very good question. I think there's two things to think about on here. We are not at Mytheo. We're not trying to time the market. We're not trying to tweak our algorithms to match a certain market condition. There are people that try to do that, and that's a perfectly valid way of investing, but it's an extremely difficult way of doing it. Our algorithms are designed to work in the long term. They're not dependent on any particular kind of market condition or anything like that. Having said that, you do want to make sure that the information in your algorithm, the information that you're using, is up to date. And we update all of the data in our algorithms every month, rerun the algorithms and see whether there's any material changes to the portfolio. In terms of other things to do with market conditions, we don't really have time to get into it today, but we do have a risk control element called AI Assist, which runs every day. And we use that to try and pick up cases where there's an abnormally high risk in a particular market. And AI Assist will try to identify that as fast as possible and shift our portfolios away from those kind of markets. But I think perhaps explaining how that works might be for another day.
Yeah, let's leave that for another time. That in itself is a full-on conversation. But we do have some really good questions to come in, guys. Please keep them coming. We've got another 7 minutes to go. So we've got one here that I think might be on the minds of a few people. How does a small investment amount in the portfolio processed, or how does a small amount that I invest in Mytheo go into all those many ETFs, right? There seems like a lot of ETFs to buy. Yeah, so maybe, Matt?
Yeah, I mean, that's an excellent question. Yes. So, and it makes sense as a question. If you think about it, say you put in, I don't know, 500 ringgits or something like that, there's no way as an individual you could go and buy one share in all of those 59 ETFs with 500 ringgit. So ETFs, their prices vary, but they're maybe between $10-$20 per ETF. And so, but the good thing about robo-advisor is we use things called fractional shares. And so because we have a large number of different investors, and when we go and buy the ETFs, we're buying them on a pooled basis. We pool all of the money together, and then we go and buy the ETFs. What that means is in your individual account, you will hold, for example, 1.25 units of a particular ETF or 0.33 units of a particular ETF. And so even though as an individual investor, you can't buy fractions of an ETF. You can only buy round numbers. When you invest via a robo-advisor like Mytheo, because we're doing it on a pooled basis, we can look after the allocation of those fractional shares across all of your portfolio. So the upshot is, even with a very small amount of money in your portfolio, you still get a clean portfolio. You still get allocation to all of the ETFs that are in there. You just, in some cases, it might be a fraction of a share.
Yeah, and it's, I guess, that comes with scale, and that, well, again, we're a digital investment manager, so we're pulling this money together and managing it on behalf of the clients here. And just to also note that the money is held in the custodian, so there is that level of separation and safety for your capital that's being, and not from a market point of view, but in terms of it being kept separate from Mytheo. We've got this is a pretty interesting question, Matt. The projection of investment return looks good, even if you just base it on a minimum 3% annual return. However, there may not be positive returns every year. Best example is this year. The Dow Jones Industrial and the Nasdaq have been down more than 20% to date. I think the Nasdaq is down like 30% since all-time highs, or 35. Since the beginning of the year, they're both down 20%. This is equivalent to 7 years of 3% returns being wiped out in a single year. Matt, what's your take on this?
Yes. It's a very, very good question. And this gets really to the one of the cores of investing. And so there will be negative returns. There will be times when the market goes down. Investing means taking some risk. If you don't take any risk, then you can't expect any return other than kind of the risk-free rate of return. And so depending on the asset that you invest in, the size of those drawdowns can vary. But certainly, as you said, like for equities, it's perfectly possible for the market to fall 20%, 30%. In worst cases, the global equity markets can fall, 40% from peak to trough. That's part of the risk that's involved. But having said that, if you look at like a longer horizon graph of those kind of returns, you notice that the market always comes back. It's extremely difficult. I would say it's almost impossible to time when it's going to come back. But the market always comes back. And that's why you get this 8.5% in the long run. When you look at an individual year or an individual period, yes, you'll have years where it's minus 20, maybe minus 30%. You also have years when it's plus 30%. I think people forget that for the last 3 years, global equities in 2019, 2020, 2021, global equities returned each year. They returned over 20%.
Oh, what a ridiculous number.
Crazy, right? Over 20%. And so it's perfectly natural that we're seeing a correction right now. You're not going to earn 20% per year forever. There will be plus years and minus years. So from my point of view, what's going on in the market right now is perfectly normal. Perfectly normal. The market will come back. I can't say when, but the best way of dealing with this kind of thing is just don't do anything. Just keep investing, keep invested, keep staying in the market. That guarantees that when the market does come back, you will benefit from it.
And that's also why I think a lot of financial planners, advisors, or just commentators always talk about dollar cost averaging, because it's easy to talk about dollar cost averaging when the market is going up. When it goes down, people start getting a bit worried. But this is when you start to average down your portfolio because you're doing it over the long term. This is why we use things like the long-term average of the market that takes into consideration post-World War II dips in American equity markets, 40, 30% drawdowns there. So this is not the first time it's going to happen. It's not the last time. Maybe we're now paying for all the quantitative easing we've seen, but over the longer term. And this is why your time horizon is important. This is why it's important to start early, because as you get closer to retirement, you will then, that allocation changes, right? Less equities, more fixed income, more safer, maybe on your with a financial planner will ask you to get some cash aside as well for 3 years or something like that. Again, that's a conversation to have with your planner. But yeah, this is why time horizons matter, risk tolerance matters, and these are all these things that we at Mytheo take into consideration. I know we're just over time, Matt, but there are 2 questions left here that I'd like to get into. One is, maybe this is a quicker one. Okay, there are multiple questions here comparing, basically asking us for the difference between Mytheo and some of the competitors out there, like Stashaway or KDI. So maybe you can just highlight, again, as an overall, we do believe that we want the entire robo-advisory market to come up in the country. But obviously, we do believe that we are the better product in certain areas, or no, we do believe we're the better product in general. So, Matt, I'll leave it over to you to take us through that.
Thank you. I mean, these are perfectly natural questions to have. So there are other robo-advisors in Malaysia, and in some sense, they kind of look similar. Everybody looks similar in a sense, all robo-advisors ask some questions, some basic questions about you, and then they build you a portfolio, and in almost all cases, it's a portfolio built out of ETFs. And so it's perfectly natural to say, well, what's the difference? Aren't they all the same? When you look at the details, there is a fair bit of difference. And I don't want to comment specifically on any particular other robo-advisor, but most of the ones in my experience, most of the other advisors, what they do is they actually have a very small number of portfolios that they provide, maybe 5 or 6 different patterns of portfolios. And what happens is, no matter what answers you put into the questions at the start, no matter what information you put into there, that robo-advisor will feed you into one of those, say, 6 different portfolios that they've got set up. And I can understand why they do that. That makes it much simpler from their point of view in terms of managing the portfolios. It's much more straightforward. They don't need to manage a whole load of different portfolios. It's just 6 different portfolios. But if you think about it from the user's point of view, the whole point of robo-advisory is that we're using technology to provide a personalized portfolio that's the right portfolio for you. In the past, this kind of personalization cost an awful lot of money. You had to have a lot of assets in order to get a portfolio that was dedicated to your needs. The good thing is that technology has lowered those barriers. It's made it possible for people like My Theo to offer that level of personalization at a much lower cost. And so the biggest difference between My Theo and some of our competitors is the fact that we have hundreds of different portfolios that you can end up in. And the portfolio that we build for you is completely personalized to your needs. And that's not the case, I think, in most of the other robo-advisors.
Matt, last question before we wrap up for today. Ladies and gentlemen, I know there are a few more questions in there, but we really do have to wrap up the session. We do these webinars every month. So please stay tuned, come and join us on our social media, register for the app. You don't have to put any money, but you'll get notifications in terms of when we do our webinars, on our content, all like that, all the things like that. But yeah, these webinar sessions from the past, the comments we've got, the feedback we've got has been always very positive, whether you are invested with Mytheo or not. We are more than happy to share this knowledge and this education with everyone out there, which is why we're talking about compounding, which is why we're talking about different concepts and not just, yes, we did talk about Mytheo, of course we have to, but it was not entirely about it, right? And we're going to continue this educational series going forward. Last question, Matt, in the spirit of education, what is smart beta? This is a question that was asked quite early. So yeah, in the spirit of education, what is smart beta?
Sure. Yeah. So this is quite a common term that people use in investing. And the idea here is there are some, in general, equity markets in particular are quite efficient. Information gets priced in very quickly. But there are some inefficiencies in the equity markets that are very persistent. So, for example, in the long run, small cap companies tend to outperform large cap companies. Now, that doesn't happen all the time, and certainly over the last few years, certainly pre the current market correction, large cap companies have been outperforming small cap. But if you look at a long horizon, in general, small cap outperforms large cap. In general, lower risk companies outperform higher risk companies. And there are many kind of behavioral reasons why that might be the case. But these are well-documented market inefficiencies. And there are a number of ETFs that we use in our portfolios that are targeted at picking up those inefficiencies. And those inefficiencies are referred to as smart beta. You're not looking to kind of time anything. You're not looking to do individual stock selection or things like that. You're picking up on a certain trait that tends to generate excess returns and build a portfolio that has some exposure. It's not completely tilted to those kind of things. But smart beta refers to these anomalies, persistent anomalies, things like small cap outperforming, low volatility stocks outperforming. A lot of investors use this. A lot of institutional investors use this as a core concept in their portfolios. And we also include it as part of the algorithm for My Theo.
Man, always a pleasure speaking with you. Looking forward to our next session, which should be in a month's time. Everyone stay tuned for that. The topics and the topic will be promoted soon enough. If you have any suggestions for what we should cover next, please let us know in the chat box or in any sort of feedback form, whether it's on social media or our Instagram. Please, any suggestions, more than happy to take them on. If you have any additional questions for Matt, also drop that in social media and we will try and create some content around that. It shows a level of interest. Ladies and gentlemen, I know it's 10 minutes past what we said the time was going to be. Thank you so much for staying with us. A lot of you have shown strong intent, staying with us till the very end. I appreciate your time. Thank you so much. Ladies and gentlemen, that was Matthew Stuart-Box, Chief Investment Officer of My Theo, and my name is Roshan Kanesan, the Head of Content and Strategic Partnerships here at My Theo. Looking forward to seeing all of you again in the next session and hoping that you guys get started with My Theo today. Cheers, everyone. Have a good night and good week ahead. Bye.
Let's take a moment to talk about money. We all know how important it is to save. But no matter how hard we work to build our nest egg, experts believe most of us still won't have enough to retire comfortably. Investing is the better way to grow your wealth, but requires years to master on your own, or high fees and starting capital to hire a wealth manager. Now, there's an easier way for you to invest. My Theo is a digital investment manager that does the work for you using investment strategies with a proven track record, helping over 60,000 Japanese investors grow their wealth. That's over $300 million of assets under management. And this is all it takes to start investing meaningfully. When you create an account, My Theo will want to know you a little better. Things like your age, assets, and appetite for risk. Once it has collected enough information, a professional investment portfolio will be generated just for you. This portfolio will consist of ETFs listed in the US stock market. Each ETF is selected for its different feature, such as country or asset class, to further diversify your portfolio, and that disperses some of the risk. This global diversification strategy is one way My Theo optimizes your portfolio. The algorithm that drives My Theo's logical investment reasoning is based on the research behind 2 Nobel Prizes. In the past, you or your fund manager would have to closely monitor the market's various moving parts every day. That's a lot of data and decision making. With My Theo, you don't have to sweat the hard stuff. It automatically rebalances your portfolio to its prime investment position. What My Theo does for your portfolio is no secret. View the rebalancing data anytime from your account, accessible via the app or website. You might even want to start calling the shots one day. Go ahead and adjust the portfolio to suit your needs. After all the money talk, here comes the money talk. Thankfully, My Theo's service will not break the bank, just a small fraction of your investment. With no sales fee, no exchange commission, and not a single surprise charge. So the question to ask yourself is this: will it be worth it? Deciding to invest may mean new commitments and lifestyle adjustments. It could also mean the freedom to do what you've always wanted, not just life's milestones like marriage, kids, and retirement, but the moments in between that make life richer. Whatever it looks like, it's time to invest in experiences that truly matter to you, because life's moments are priceless.